All right, well, let's get started. It is 10 o'clock. I like to start on time. Don, can you hear me okay?
Okay, I can hear you. Want to
All
get
right,
started?
fantastic. Yeah, go ahead and do a quick introduction
Okay,
of me, and I'll finish it up, and let's get started.
okay. Good morning, everybody. My name is Don Mulcahy, and I'm the marketing director for HECM Association. And this program is on the HECM Home Purchase Program. And this is a presentation is a 2-hour presentation, including 2 CE credits. And this program will give you information on an alternative home mortgage for your senior borrowers. That will help them purchase a home. There'll be 3 ways to purchase a home. This particular program, the HECM Purchase Program, cash, and a regular mortgage. So I hope you find this interesting, informative. And without further ado, I will introduce Tim Linger, who is the president of HECM Association, and we'll proceed with the program right now.
All right. All right, thank you, Don. So once again, my name is Tim Linger. I'm a certified reverse mortgage professional, which is a very prestigious designation. There's only 200 of us in the entire nation that have actually achieved this level of professionalism, expertise. And again, that's CRMP, Certified Reverse Mortgage Professional. I'm also a certified HECM specialist, which is the legal name of the FHA reverse mortgage. We'll get into that in a moment. And I'm also a certified senior advisor and have been for 25 years. And so everyone knows I come from a position of strength. This is my 26th year exclusively in the HECM reverse mortgage world. I do not do traditional mortgages personally. The company that I work for does. And my primary job, my primary income is a reverse mortgage loan officer. My company does other types of mortgages, so we're well rounded in the mortgage space. But today we're talking about the HECM, reverse mortgage for home purchase. So you get 2 hours of continuing education. People need to participate in this conversation. I would prefer your video to be on so we can all see who you are. It is optional, but it would be nice that we can put a name with a face with along with the question. I would like everyone to participate in this presentation. In other words, ask me questions. And the way I like to do my presentation is I don't like to wait till the end to accept questions. I would rather you raise your hand or interrupt me. When I come to a period, I'll stop and answer your question. On occasion, I might say, well, that's coming up in a couple of slides. Otherwise, I'll just answer it right then. By answering it right then, chances are in a couple of slides, I'm going to skip over those slides because we've already answered the question. But to me, that's the best way to learn. You've got the visual in front of you and you have the immediate answer to your question so we can keep the conversation alive. I especially want to hear from people that think they understand about the HECM reverse mortgage and don't like them because I want you to ask me some of the tough questions. And if anybody has even an inkling what a reverse is, but you've never taken a course on it, then I want some questions to be asked to me as if you were a client, somebody that's 62 and above, that would that might be negative to this program. I've heard that if you do this, I'm going to lose my house. The bank's going to take the house. This is the government's way of stealing your home. I want to hear those kind of bad questions. I've been doing this long enough. You're not going to trip me up. So the meaner the question, the rougher the question, the better I like it. So whether you believe it or not, throw some tough questions at me. All right, for those of you just joining us, you haven't missed a thing. All right, moving on to the first slide. What the heck is a HECM? Home equity conversion mortgage. A reverse mortgage is a way to take home equity and convert it, providing cash now and make it a mortgage. It's just that simple. We're going to convert home equity into a loan. The nice thing about the HECM, in particular the FHA HECM, is that it's a no payment required mortgage. It's a mortgage, but no payments are required. Now, I would assume that nobody on this call is against a mortgage. Most houses are sold with mortgages. Of course, there's certainly cash buyers, but most houses are sold with mortgages. So no one should be afraid of a mortgage. A mortgage, the definition of a mortgage is where someone buys a house, and I'm just going to make it simple, of course. Someone buys a house and finances that house with the local bank, right? The bank has to protect their interests, so they put a lien against it. That's a mortgage. Now, in exchange for the lien and the money in order to buy the house, the customer agrees to set up a monthly mortgage payment. Now, of course, there's different flavors of mortgages, but at the simplest of all this, a monthly mortgage payment would be for the next 30 years, monthly required payment for 30 years. And if you don't follow the contract, meaning paying the property taxes, the homeowners association dues, the upkeep of the house, then the bank can foreclose on the property, right? That's fair enough. That's a mortgage. We can call this a VA mortgage, an FHA mortgage, a conventional mortgage. You can call it what you want to. We can call it a reverse mortgage. But at the end of the day, a mortgage is exactly what I just said. It's a lien against a property, usually by a lender. Okay, fair enough. If anybody disagrees, please throw it out at me. So no one should be afraid of a VA loan or an FHA loan or conventional loan or reverse mortgage. If it's a reverse, it's still a mortgage. Okay, so I'm going to say in simple words, a mortgage is a mortgage is a mortgage. A bank puts a lien against the property that you own. And as owner of the property, one more time, you pay the property taxes, the HOA, and the upkeep, right? So whether it be a reverse mortgage, a USDA mortgage, it's still a mortgage with a lien, a house with a lien against it. That's the simplest way of putting it. So with that in mind, sort of keep that at the front of your forehead while we go through this presentation. So we can go way back to 1961, and the reason I want to do this is that this program's been around for over 60 years. Now, it hasn't been insured by the federal government except for the last 35. But let's go back to 1961. The story goes that a little old lady named Nellie Young in Maine lost her husband. He was a very popular, it was a small town, a very popular high school football coach. And he passed away and left his wife with little money. Yes, she had Social Security, but did she have a pension from her husband? Did she have any other income? The fact is that she was broke, and she was scared that she would not be able to live in her house the rest of her life. So she went down to the local bank, savings and loan, and asked for some kind of a loan, and they turned her down. A, she was a female, and yes, that was a thing back then. B, she didn't have enough money to qualify for a loan. And because it was a small town, it was a savings and loan, it was all about community banking. They worked out a deal with her. They said, I tell you what, if you give us the deed to your property, we'll give you money. You can stay in the house the rest of your life, and when you die, the bank takes your house. Whoa. Now, maybe this was the beginning of the bad reputation of this program, but it took hold. And the UCLA professor, Young Ping Chen, looked into this and thought it was a pretty cool idea. It was sort of like a housing annuity or like a Social Security where the bank would pay a person money every month or a lump sum in exchange for the property. So the Senate Committee on Aging took special interest in this, and they had hearings. In the 1980s, 1984 in particular, the American Homestead Act set the foundation for some kind of a national reverse mortgage. They called it the Century Plan. So now we're 2 decades, 25 years past this first reverse mortgage. In 1987, Congress passed the FHA insurance bill called the Home Equity Conversion Mortgage Demonstration, the HECM demonstration, which was a temporary test run on maybe some kind of a reverse mortgage pilot program could work. So they did that for a number of years. And for those of you that are older, you might remember the second sentence. It says, proposal by Senator John Hines. I'm turning 60 next month, and I remember Senator John Hines. But in 1988, Ronald Reagan signed this into law. The federal government FHA HECM refinance program was launched. And the very first refinance HECM, not a purchase. Now, this program is about the purchase program. But the first refinance HECM, reverse mortgage, was started in 1989. And I actually met the guy. He actually used to work for me years ago, who actually wrote the very first loan application, the very first reverse mortgage loan application up in the Baltimore, Maryland area. And he wasn't blessed with closing the first loan. That was done out of the Midwest from JB Nutter and Company. But he wrote the first application. The first loan closing was elsewhere. So fast forward to 2009, 2010, the HECM for home purchase was authorized. And part of that was because of the 2008 housing crisis that we had. And the Obama administration was looking for a way to sort of jumpstart the economy. And coming out with a purchase program was one of the solutions. So once again, this program is primarily about the FHA, the federal government's HECM for home purchase. We're also going to be talking about the portfolio home purchase or the portfolio private. Uh, um, Proprietary is another word for it. It's also called a HECM for home purchase. We're going to touch a little bit on the refinance, but we're going to focus on the purchase. Everybody here is most likely a realtor, or you're at least in the real estate business, or you wouldn't be here. So we're going to be focusing on what you can do to increase your sales and help your clients at the same time. So before we get started, is there any questions at all? Any comments at all? Okay. Now, one thing about me is I like to start on time, which we did, and I like to end on time. In fact, if we can end a few minutes early, I wouldn't complain. We'll take a 10-minute break at the top of each hour. So we'll get one 10-minute break and maybe one at the very end if we can finish early. But let's talk about reverse mortgages because that's just a nasty word. As soon as you mention reverse mortgage to your clients, they're going to put their fingers in their ears and they're going to close down. I'm not interested. And if you try to question them, they won't have the right answer. Well, I was told by my first cousin's brother's neighbor's father that he lost his house due to reverse mortgage. Well, how did that happen? I don't know. I'm just not interested. So a reverse mortgage is actually a slang. The legal name of this program is home equity conversion mortgage, a HECM. Right? That's written into law. Except going back to the 60s, to the 80s, to the 90s, this program has always been called a reverse mortgage. Now, common sense says that a regular mortgage, let's call it a forward mortgage where you forward a check to the bank every month for 30 years to eventually you own it free and clear. Well, a reverse mortgage must be the opposite of that. It must be where the bank pays you every month and eventually you don't own the house. Okay, that's logical, but it's not the answer. A reverse mortgage just means that there's no required monthly mortgage payments. So I want to get the word reverse out of our language. I want everyone on this call, everyone in this presentation to start calling it by its legal name, a HECM. We'll never get rid of the word reverse mortgage because looking at the screen right now, it's like a dog. There's all sorts of breeds of dogs. There's poodles, there's German shepherds, there's Rottweilers, there's guard dogs, there's good dogs, there's bad dogs, there's lap dogs. They're all dogs. But if you were a breeder and you were raising greyhounds, you wouldn't put an ad in the paper, dogs for sale. You would put greyhounds for sale, poodles for sale. A sweet Shih Tzu is for sale, right? Yeah, you're a dog breeder, and yeah, it's a dog, but you're selling a particular type of dog if you were a dog breeder. So let's call our dog, our reverse mortgage, by its legal name, which is HECM. Now, for those of you who want a second analogy, it's like a fruit. A lemon is sour, a strawberry is sweet. They're both fruits, but one is sweet and one is sour. So let's call, if you were to set up a fruit stand selling strawberries, you would call it a strawberry stand, not a lemon stand, unless it was a lemonade stand. Or unless you're selling a lot of different types of fruit, you would call it a fruit stand. Otherwise, you would specialize and say this is a grape stand, a banana stand, a strawberry stand. All right, now that we're past that, let's go back into the HECM for home purchase history. And I don't want you to remember this stuff because it's not important, but this program's been around for about 15 years. It started effectively in 2010, signed into law in 2008, started in 2009, but there was a lot of bugs to be worked out. And finally, FHA got it right and officially got it as best it could be by 2010. And that's when this program really started taking off. Now, even though it's 15 years old, 16, 17 years old, most real estate agents have no clue, which means that everyone on this call today is miles ahead of your competition, miles ahead. According to NAR, only 3% of the real estate agents in the entire United States have even a clue that this program even exists. Only 3%. I'm not saying 3% of realtors do this program. I'm saying 3% don't even have, 97% have no clue that this program even exists. So you are definitely way ahead of the crowd. Hey, Don, if you could do me a favor and keep an eye on the chat, and if there's something that pops up that I need to know about, um, please let me know. Right now, it looks like what's in the chat is, oh, here we go. Here's a question from Julia. Can this buy a primary residence or investment property? There we go. First great question of the day. All right, so Julia, this is a primary home purchase only for the FHA program. Now, the portfolio loans, meaning the private banking loans, do have some other options, and we'll discuss those a little bit later. But for the most part, in almost 100% of the time, this is for your primary home only, not secondary homes, not investment properties. Okay. So in general terms, a type of loan that has no required, and you're going to hear me use the word no required and optional multiple times, a program that has no required monthly mortgage payments is a type of reverse mortgage, not necessarily the FHA type. So for an example, the Federal Trade Commission recognizes three types of reverse mortgages. They recognize the FHA, the HECM, the best and the safest, and it's best by, it's subject to what you think is best, because the other programs are very good as well. And again, we're going to discuss each one briefly, but we're going to focus on the FHA HECM. The single purpose reverse mortgage. Now, they don't call this a reverse mortgage, but the FTC recognizes it a single purpose. So it's usually a property tax deferral. Every county in the state of Florida, and probably across the nation, but definitely Florida, every county has a property tax deferral program for senior citizens. Now, I don't know about your county, but Orange County, I live in Orlando. Orange County's property tax deferral, you have to be of low income, you have to be 62 and above, you have to have low assets and low income, household income. So if you're living with your kids, that's part of the household income. And if you qualify, the county will waive your property taxes for the, well, let me rephrase that. They'll defer your property taxes for the rest of your life, as long as you qualify, unless you get a bunch of money, like you inherit something. So let's just say your property taxes are $1,000 a year or $2,000 a year, let's just say. You're a senior citizen, you've owned your house, you've done fine financially, and then something happens in your life, your spouse passes, whatever the situation is, and now all of a sudden you can't afford your property taxes, not comfortably. You can apply to the county will defer your property taxes for the rest of your life. It does not waive them, it just means they're deferred. No different than a reverse mortgage where your payments are deferred. Eventually, when the property is sold, when the homeowner leaves, the property taxes come due. But if it allows a senior citizen to stay in their house for the rest of their life, then this is a wonderful option. Single purpose, usually a property tax deferral reverse mortgage. The proprietary is very similar to the FHA HECM, but proprietary HECM just means that it's not insured by the federal government, but it's offered by banks, lenders, investors. It's sort of like a jumbo mortgage, right? The federal government doesn't offer multi-million-dollar mortgages, right? The FHA, the VA, there's lending limits. So if your client is looking to buy a $5 million property, they're not going to get a government loan. They're going to get a proprietary loan, a jumbo loan. All right. Any questions? Again, I'm all about questions, so start thinking of some. Okay, so the purpose of that last slide was to realize that you really can't just throw out the reverse mortgage and know exactly what you're talking about. It's sort of like a dog, right? You start talking about dogs, and in their mind, someone's thinking about a nice lap dog, a poodle, a Shih Tzu. But what you're talking about is a guard dog, a German Shepherd, a Rottweiler. So you can't just use reverse mortgage in generalities, because not all dogs are mean, not all dogs are nice. So a HECM, home equity conversion mortgage, is a type of reverse mortgage. It's not the only reverse mortgage. Just like a strawberry is not the only fruit. So I believe that the FHA HECM, which probably takes 95% of the market share, happens to be the best and the safest kind, but it's not the only type of reverse mortgage that's right for your clients. I can't stress that enough. I personally like Shih Tzus and Poodles, but it's not the only dog available. If I wanted a guard dog, maybe I'd get a Pit Bull or German Shepherd. If I want a seeing eye dog, in my mind, when I was growing up, German Shepherds were the only seeing eye dogs out there, and now there are all sorts of breeds. But the FHA program is sponsored by the Federal Housing Administration. It's insured by HUD. It is a has a fantastic reputation and satisfaction rate. According to a AARP study about a decade ago, 96% of everybody that has ever completed their very own FHA HECM loved them. Now think about that. That's not 4 out of 5 stars. That's like 4.96 out of 5 stars. That means just about everybody is giving the FHA HECM 5 stars. Yet, when you ask people on the street, what do you think about a reverse mortgage? They close their ears. No, that's a bad thing. That's a bad thing. How can something with 5 out of 5 stars be a bad thing? It tells me that they don't understand it. Because by the time this presentation is over, you're going to go from either not thinking reverses are a good idea to maybe liking them, but no, you're going to be all the way up to the love category. When we're done here, you're going to say, wow, mama didn't know. This is the best thing since sliced bread. All right, any questions? We're rolling along here. All right, so remember this. The HECM has no required monthly mortgage payments. All right, a mortgage payment is due sometime, but they're not required on a monthly basis, which is a financial game changer for those that are retired. The FHA requirement is that you must be 62 in order to do this loan. So you must be in the retirement mode. You don't have to be retired, but you have to be in the 62 age range. Now, a spouse, which I'll discuss more later, can be of any age, 50, 55, 45, 35, whatever, but the primary borrower must be 62. The proprietary loans go down as low as 55. So if you got somebody that wants to start early, maybe they're retiring early, maybe they're disabled, maybe they just want to do one at 55, they are available under the proprietary programs. So whether we're talking about a HECM for home purchase or a refinance HECM, the program is still the same. Right? So this is where it starts getting complicated, but it doesn't have to be complicated if you keep it simple. Boy, there's a tough one to think about, to digest. So we'll get into that in a little bit later, and I'll give you some examples. But in order to purchase a home, a person needs to put about 65% down. Okay, this is not a 3.5% down kind of a program. This is a program for people who have a substantial down payment but don't want a monthly mortgage payment. And many retirees fill into that category perfect. They decide that they want their retirement home, and the retirement home costs $400,000, but they don't have $400,000, and they either don't qualify for a monthly mortgage payment or they don't want a monthly mortgage payment. So if they don't have $400,000 cash, what do? Maybe they come up with their $250,000 down payment, i.e. 65%, and just buy a $250,000 house. Now, here's the first question I want to ask anybody. Please answer this verbally, preferably verbally. If a customer comes to you, this is a serious question. If a customer comes to you with $250,000 cash money, all right, cash money, and they tell you to sell them a home for $250,000, what's the first thing that hits your brain? They don't want a mortgage payment now. What's the first thing that comes to your brain? Anybody?
A 55 and up community.
Okay.
Well, after how you explain it, the HECM then.
Well, that's a good answer. It's not the one I'm looking for, but that was a great answer. 55 plus community and Vivian. All right. Excellent. But let's keep going.
Maybe a fixer-upper?
All right. Fixer-upper. All right. So you're on the right track, but I'm going to give you the answer that I would give. There is no home for sale for 250,000. All right, maybe a fixer-upper. There's no home, probably in the entire state of Florida, unless you go to some nowhereville. You can't buy, you can't, not the home that they want. The home that they want is the golf course with the jacuzzi and the swimming pool and the conservation view, the waterfront, right? That's the house. They're in retirement mode. They want what they want. But you're showing them fixer-uppers now. You're showing them manufactured home 55 plus communities. Now, then you remember, oh, wait, we have this HECM for home purchase. I can get you into a $400,000 house with no required mortgage payments for a $250,000 down payment. Now, interest is going to be about 6.5%, which is normal for any kind of mortgage right now. But there's no required mortgage payments. They still own the house. They still pay the HOA dues, the property taxes. They can still sell it at any time. They have to be 62 and over to do this loan, but no required mortgage payments for the rest of their life. The home value on a $400,000 house is going to go up faster than the home value, the equity of a $250,000 house, right? Percentage-wise, 4% is what the national average is. Homes increase at 4% a year. 4% on a $400,000 house is a $16,000 average increase in value, where a $250,000 home would give a $10,000 increase in value. So believe it or not, even without a mortgage payment on a $400,000 house, they're actually building their net worth faster than they would if they paid all cash for a $250,000 house. And they get a house that's more their lifestyle preference.
What happens if they sell the house? Like, say they buy the house, 400,000, they put $250,000 down, year and a half, 2, 3, 4 years later, 10 years later, they want to sell the house. Now it's increased in value. Who gets the value?
Your clients do, the seniors. So remember, a mortgage is a mortgage is a mortgage. If somebody were to go out, and thank you for the question, Lori. If somebody were a veteran and they bought a $400,000 house with no money down, right? The day of closing, they owe $400,000 on a house that's worth $400,000. There's no equity. So using your example, 5 years passes. 5 years at $16,000 annual growth means that their home value is now worth $40,000 more. Now they're living in a $440,000 house that they owe $400,000 on, because guess what? They haven't paid any of the principal in the first 5 years of their mortgage payment. If you do an amortization schedule, the first 10 years, almost all of it goes to interest. So they still owe $400,000, maybe $399,500, but they still owe $400,000. But they've got $40,000 of equity. They sell the house, not counting real estate fees and closing costs, and they walk away with $40,000. So the reverse works the same way. Now, the last 5 years of this VA example, they've had a mortgage payment for 5 years. They've had $3,000 a month mortgage payments, and they have nothing to show for it except for the value of their house increasing. The HECM, there's no required mortgage payments, so they don't owe $250,000 anymore. Now they owe 6% more every year for the last 5 years. Now they owe, I'm just going to do quick math, 6, 12, 1,500, they owe $75,000 more. So now they owe $325,000. That's probably bad math. Let me try this again. 6, 12, 15 times, 75,000. I'm using brain math, so don't use a calculator. It's close. So now they owe $325,000 on a house that's worth $440,000. So they've increased their net worth, and yet they haven't paid $75,000 in mortgage payments, right? So if they look that as a gain, that's $75,000, because that $75,000 went in their pocket, right? Went into their retirement pocket. Plus, they've still increased their home's value. So they're in a better position financially on a daily basis and financially on a 5-year basis with a HECM.
But wait, if it's a $400,000 house and now it's worth $450,000, you said they would get the 50, but what happened to the $250,000?
Okay, so now we're using the reverse as the example. So your client decides to buy a $400,000 house. They put $250,000 down payment. Oh, actually, I did the math wrong on that. All right, so they put $250,000 down to buy a $400,000 house with the HECM. Okay, if you want to get a pen and write this down, it might make it easier on the brain. So they're putting $250,000 down, and they're buying a $400,000 house. They're financing $150,000, right? They're financing $150,000 into a HECM. The interest is going to be 6%. I'm just going to use simple interest right now. I think the interest rate right now is 6.5, but I'm going to say 6%. So 6% on 100,000 is $6,000. On another 50,000 is $3,000. So their interest every year that they don't make a payment, right? They're not making a payment on the $150,000 loan, is going to accumulate by $9,000 a year. So over the next 5 years, they have not made $45,000 in mortgage payments, right? They financed 150,000. They put 250 down. Now their loan balance has gone from 150 to 195. Right? They've made no payments for 5 years. They did not make $45,000 worth of mortgage payments. Now they owe 195,000. But their $400,000 house is now worth 440. So they've pocketed $45,000. This is retirement money now because they're 62 and above. They've pocketed $45,000 of not making the mortgage payments, and their house is worth $440,000 5 years later. That's a beautiful thing in retirement.
So then when they sell, like say 440, what do they owe the bank? The
So-
195?
They owe the bank 195. The difference is theirs. Yep. Or if
So-
they pass away, then the kids get the house.
Okay, so they're not making the mortgage payments, but they are still losing money.
And how are they losing money?
Well, if they buy the house for because I wrote it down. If they buy the house for 400, they put 250 down. They're really financing 150, 6% interest, compounded over, yes, about $9,000 a year. So in 5 years, they've made no payments. They haven't paid the 45,000, but now the loan has 45,000 on it. So now they owe the bank 195. If they sell for 440 minus the 195, they've lost. But at the same time, they haven't made payments.
Wait. The difference between 440 and 195 is 255.
Okay.
So now they have $255,000. And again, we're not talking about real estate fees and closing costs. We got to keep it simple.
Yeah.
But now they got $255,000. Plus they have $45,000 worth of payments they didn't make. That's a savings. They probably spend it on cruises and fun stuff, but that's okay.
And if
So
they
they're
pass
not-
away, the house goes to the kids. It doesn't go automatically to the bank. Because I think that's where I always thought like
Yeah,
a reverse
Yeah.
mortgage or whatever you want to call it, right? I always thought like
Right.
it goes to the bank when you die.
that's correct. That's one of the things I've been fighting for more than 25 years. It's that's the big misconception. So remember, a mortgage is a mortgage is a mortgage. They all work the same way. The bank puts a lien against the house. The bank doesn't want the house. The bank's in the money business, not the housing business. So this is just a mortgage with no required payments. This is just a mortgage with no required payments. And when that can sink in, which I know is hard, it truly is. I'm not picking on anybody in particular because I've been fighting this for years. It's hard to wrap your mind around stuff. What do you mean no payments? How does the bank make any money? Well, the bank makes money 5 years away or 10 years or whatever it is. You know, money's a big circle. It goes to Wall Street. All the money goes to Wall Street and it comes back. Right? Everything is bundled up in bundles and sold to Wall Street. And Wall Street has, investors that are 30 and 40 years out. So everyone gets paid now. I'm a mortgage broker. When I do a loan, I'm not waiting 30 years to get paid. I get paid now because someone has bought that paper. And then someone else has bought that paper. And it just goes to Wall Street eventually. So everyone gets paid. When a bank loans money for a car, the bank has sold that car note to somebody else to pay the bank back so they can keep making car loans. So let me answer these two questions. The first one's from Julia. HECM for home purchase. How can a homeowner access equity from their current primary residence to purchase a new primary residence, given that the existing home will no longer be their primary after they move? So they'll lose their existing home if they use the HECM for home purchase. Okay, so that's probably a two-part question there. So you're taking somebody who wants to take their existing home and they want to go buy their retirement home. There's two options. What most people do is they sell their primary home and they use the money from that home to buy their next primary home. And we can do a simultaneous closing on that. If a person wants to keep this primary home and buy a new primary home, as long as they can financially afford both homes, that's okay. Just remember they have to have a substantial down payment for their new home they're buying. Now, I've met many people, like a true example is a recent closing I had. The guy was moving down from Maryland to Florida, retiring to Florida, had lots of money in the bank, lots of money in the bank. He wanted to keep his Maryland home as a rental property, and he wanted to buy a $500,000 home in Florida. He reached into his investments and he pulled out the amount of money that he needed to buy this $500,000 home. He had enough income in retirement to be able to afford the home in Maryland. Of course, he's going to rent it out. But he can afford the home in Maryland. He can afford the home in Florida with enough cash to buy it with the 65% down. So the answer is yes, they can sell their home and buy the next primary home, or they can keep their home as long as they can financially afford both homes. There is no limit on how many homes a person can own. If they're kind of a real estate tycoon and they own 10 rental properties, 15 rental properties, we're okay with that, as long as they can afford that kind of investment. The next question I have is, are the owners required to pay for and attend counseling class for a HECM specialist before a mortgage lender will assist them with obtaining a HECM? Well, first of all, a mortgage lender will definitely assist them in advance of doing the counseling. And we can actually do an application before the counseling is required. But yes, the counseling is required. It's about $150 for 30 to 60 minutes worth of telephone counseling. It really is a neutral third party to make sure the person understands the good, bad, and ugly of HECMs, because every product in the planet has good, bad, and uglies. Now, home ownership is not for everybody. As an example, some people don't have the what do you call it, the discipline to pay their property taxes, their homeowners insurance, upkeep. So my understanding is that the class is needed to ensure that they're aware of the HECM and it knows how it works and how it can benefit them. That's correct. It's a neutral third party that's going to ask them a bunch of questions to make sure they understand that even though it's no required payments, it's still a mortgage. And eventually the mortgage is going to come due. The mortgage is going to come due when they're no longer occupying the home. They've sold it, they've died, whatever it is. It's a lifetime loan. It's a lifetime deferred monthly mortgage payment program. And the next one is from Megan. Megan is on a basic auto plan with 30-minute meetings. Oh, wait, never mind. That's some kind of an AI thing. Well, we'll scratch that. Okay, so Lori, did I answer all your questions?
Yes, and so when the person passes away, it goes to the children. The children can still sell the home, and if there's any equity left, it's theirs.
Correct. The children will have all the full options that anybody would have, even if they didn't do a HECM. In other words, the kids may want to keep the house, right? All the lender wants is their money back. The lender is just a bank, no different than any bank that you're aware of. Usually it's a bank, it could be a lender, but the lender wants their money back. So if the kids want to go out and get a mortgage in their own name and pay the money back in a lump sum, they can. If they want to sell the property, they can. If they happen to have the cash in the bank and just pay it off, they can. Just the bank wants their money back, and they're going to give them upwards of a year to pay us back in a lump sum. There's no required mortgage payments, not even for the kids. But when mom and dad dies, the clock starts ticking. The kids are given 3 months to make a decision to sell, keep the house. A 3-month extension with potentially another 3-month extension with potentially another 3-month extension for upwards of a year. And that's the sort of the quick answer. I think I raised my own hand.
Hey, Tim,
Yeah,
Tim, the children can also walk away from the house. They don't have to, they don't want the house. They can just say, no, we're not interested. If it's
that's
upside
true.
down, what is the benefit if the house is upside down?
Okay, that's a good question. Let me hold that answer for a few more slides.
Okay.
But that is absolutely a strong option. Was it Milan? Or do you have a question?
Yes. So being as though this is an FHA, are there any requirements of staying in the home a certain amount of time prior to selling?
No, no. Technically, I mean, there's closing costs, right? Real estate's expensive. So you wouldn't want to buy a house today and sell it next week. But no, but you could. I've had clients that have done this, and 6 weeks later they died, and that's unfortunate, of course, but it's life. And kids will put it up for sale immediately. So there is no prepayment penalties. There is no requirement for how long they have to live there. If they live 50 more years or 5 days, it's all the same. Okay, we have 10 minutes before the break, so let me move on to the next slide. Thank you, Don, for that question. And we're going to get into the non-recourse feature very, very soon. So let's talk about this 65% real quick, because 65% is a substantial down payment. I've had real estate agents say, well, I don't need this program because all my customers pay cash. Well, good. Maybe they would buy a nicer house if they knew that their cash could be larger. So 65% is the basic down payment. The way the program works is the older you are, the more FHA is willing to lend because your life expectancy is shorter. The lower the interest rate, and we're in interest rate decline right now. The interest rates are coming down. So the lower the interest rates go, the more FHA is willing to lend. And that's important because every time we get a rate cut, I get excited because now we can lend more than 65%. So if a person is 90 years old, we might be able to loan 70% of the value of the house. I'm sorry, 40% of the value of the house. Where a 62-year-old, their down payment might be 66 or 67%. The 65% down is just something simple that we can do in our math. But here's what I like to do. I like to do things in reverse because I'm a reverse specialist. So if someone came to you and said, I've got $300,000 cash money, sell me a home. Well, half of 300,000 is 150. So it gives them a 50% boost in purchasing power. A $300,000 home gets them a $300,000 cash gets them a $450,000 home. $400,000 cash gets them a $600,000 home. $600,000 cash gets them a $900,000 home. So one of your questions as a professional real estate agent is, how much money are you comfortable putting down on the home of your dreams? If the answer is, well, I've got $500,000 cash that I'm willing to spend, then math in your head is 50% boost in purchasing power. We can get you into a $750,000 home for the same $500,000 cash, and you'll have no required monthly mortgage payments. If a person wants to make a mortgage payment, by the way, they can. They're just not required. But we can get you into a $750,000 home with no required payments for the rest of your life for $500,000. Now, the loan officer's job, the lender is going to make sure that they can afford this house. Can you afford the property taxes? Can you afford the homeowner's insurance? Do you have enough money to buy groceries? We're gonna look at their income. We're going to look at their not credit score, but credit history to make sure that they're responsible enough to be homeowners. And we're going to make an educated decision. Now, the good news is we don't have a debt to income ratio in our world. We don't have a loan to value ratio. All we care about is, can you afford this? So let me give you an extreme example. If someone came to you and said, sell me a home, I make $10,000 a month in income. The first thing in your brain is, well, this is great. I can get you qualified for anything. But when the credit report is pulled, they've got $9,000 worth of expenses. Someone's got to pay for that Cadillac and their credit card debt. They have $9,000 a month in outgoing money, and their income is 10 grand. Well, they don't qualify for squat, right? You're not selling them a home. You're not selling them a home because no lender is going to loan them the money. But in our world, in the HECM world, a married couple has to have $886 a month in extra income. In other words, they can have $9,000 worth of expenses and $10,000 a month in income. But as long as they have $886 to buy groceries and pay for their cell phone, they qualify for this loan. If their credit score was 550, 500, as long as they've paid their bills on time, they show some credit worthiness, we don't care about the credit score. What we care about is, do you have enough income to be able to afford this home? because we're going to look at whatever shows up in the credit report. We're going to look at the property taxes on the house that they're buying. We're going to look at the homeowner's insurance on the house that they're buying. We're going to look at the homeowners association on the house that they're buying. And we're going to determine, do you have $527 a month as a single person or $886 as a married person to be able to qualify for this home? And guess what? If they do, they qualify, which means that most people qualify for this. Okay, we have 5 minutes till break. Any questions? All right. So as I mentioned before, the FHA program, which is 95% of the HECM industry, the program starts at age 62. The spouse can be of any age down to age 18. The portfolio proprietary program, I like to call it portfolio because proprietary, aka jumbo. Proprietary sounds like predatory, and I'm not a big fan of predatory loans. Portfolio is the one I use, but I switch them back and forth because I've been saying proprietary for so many years. The portfolio loan sort of sounds rich, but they mean the same thing. But that program starts at 55. And remember what I said before, I didn't say it this simple, but I'm going to say it this simply now. We look at three things: the youngest person's age, what is the home's worth, and what is the current interest rate. And they use those three factors to determine how much we're willing to lend. So if you have a 55-year-old wanting to buy a house, and the interest rate is, well, it is what it is, and the house is worth, let's just say $1 million just for simple math, it probably won't be 65% down because they're 55 years old. The down payment might be 75% because they're so young. But remember, the benefit is that there's no mortgage payments for the rest of their life. Whether they're disabled or not. I've had 55-year-olds come to me and said, well, I'm disabled. I'm 100% disabled. Why can't I get more loan? My life expectancy is only 10 years. Well, sorry, we don't look at health. We look at the credit. You know, are you paying your bills on time? We look at the current interest rate. We look at your age, and we look at the value of the property to determine how much we're willing to lend. And if someone has an 850 credit score or a 450 credit score, the loan to value is the same for everybody, regardless of their credit score. Can you afford it? All right. So I sort of like this one. When a senior says, I want to pay cash for my home, what they're really saying is they don't want a mortgage payment, right? No one truly wants to give up all their cash to buy a home. They're willing to do so because they don't want a mortgage payment in retirement, right? Is that fair? I think it's very fair. No one wants to give up all their cash because you never know what the future is going to hold in retirement. Let me give you an example, then we'll call a break. We got 2 minutes. Let's say that a mortgage guy sitting in his office, an income, a couple, husband and wife comes in and sits down and says, we're both 62 years old. We have lots of money in the bank. We're both we have the best careers of our life where we have all this income. Life is perfect. Our credit score is 850. We got whatever we want to put down on a house, but we don't really want to. We want to put just 20% down. We want a loan for 80%. And the loan officer is just salivating. Oh, this is perfect. But you got to stop and think about this. And this goes to the real estate agents too. You got to stop and say, what's in this client's best interest? Does it make sense for them to pay cash for this house and drain their savings to a substantial amount? And the answer might be yes. Or does it make sense to get a 30-year mortgage at age 62, which makes them 92 before they're paying the thing off? That might make sense. But what's going to happen in the next 30 years? They're married. Life is great. But one of them is going to pass away. I mean, that's life, right? They're both going to retire, which means they're going to go from this fantastic income down to a lower amount. And maybe they've set their life up perfectly and they get a pension and they have an IRA. Maybe, I don't know all the facts, but the point is that life is not going to be perfect for them for the rest of their life, not for the next 30 years. Maybe doing a HECM of some sort where they have no required monthly mortgage payments going out. Maybe that makes the most sense. Because again, one of them will become single in their lifetime. They're going to have less income in their future. There's going to be some health issues, maybe some long-term care issues. If they have kids, well, kids are a drain on mom and dad, no matter how old they get, right? They're going to have life events. And it makes a lot of financial sense to have a financial advisor say, well, let's look at this over the long term. Let's project this out to age 95 because that's the going thing now. And let's see if you have enough money to sustain retirement with all the scenarios that could happen in life, a housing recession, an economy recession, a Great Depression. Let's look at all the things. What if? What if one of you have long-term care for 5 years and then you die and your income goes down? What if? What if? What if? And financial planners have determined that if you do not use home equity as part of the retirement plan, no matter how wealthy you are, if you do not use home equity as part of your retirement plan, you're not going to make it to age 95. All right, I have 11 o'clock. All right, hopefully everyone's back. All right, here we go. So I'm going to answer Vivian's questions first. Is there a limit on income? Thank you, Agnes. Well, that's a tough one to answer. My quick answer is no. There is no limit on income. First of all, there's no upper limit. Definitely no upper limit. But what about lower limit? Well, you know, I've met people that live on $800 a month income. I don't know how they do it, but they do. And do they qualify? They do, as long as when we pull their credit report, that they pretty much don't have any debt that's going to show up in their credit report. I mean, you have the debt that a person has if they're already a homeowner, right? There's no way they would well, yeah, they would. So if they're already a homeowner, then they have property taxes, they have homeowners insurance, maybe an HOA, and then they have the cost of running the home, electric, water, sewer, things like that. So what we're going to do for that person is we're going to determine how much their monthly outgo is. So let's just say their property taxes are low and it's $100. Let's say their homeowner's insurance is low and it's $100. Now we're at $200. They don't live in an HOA. And let's say electric, water, sewer, we estimate at 19 cents a square foot. Maybe that comes out to $50 a month. Now we're at $250 outlay. And then they have nothing on their credit report. We're just going to make this a perfect. There's no car payment. So they have $800 a month income. They have $250 outgoing money. And the difference between $800 and $250 is $550. So they have $550 to work with. They're a single person. They have to have $527 a month left over after paying all their bills in order to qualify for this loan. So hopefully I didn't go too fast, which means they have $23 left over a month to buy groceries. Well, no, not to buy groceries. They have $527 a month worth of slush money to buy groceries and pay their cell phone bill, which means there's a $23 extra amount that we don't even need to consider. So in that example, they qualify. So probably the answer is if they make less than $800 a month, there's probably no chance in heck that this is going to work for them. Now, fortunately, I haven't run across an $800 a month person in a long time. But I remember when I got into the financial services business 35 years ago, $800 a month was not uncommon. A lot of my clients were living on $800 a month. But fast forward 35 years, and $800 would be equivalent to today of, $2,500, right? Because of the cost of living, adjustment, things like that. All right. Next question is, if they enter a nursing home, does the note become due? The quick answer is no. When the home is no longer their primary home. So in other words, if they move into a nursing home permanently, then the home is no longer their home, right? It's a property. But what makes permanent? Well, permanent means that your intentions of coming home is not there anymore. Well, what if a person's intention is to always come home? Well, then the next barometer is, well, if they're gone for 365 days in a row, then they're not living there. Then the loan would come due. And that would make sense. If you're in a nursing home, if you've been gone for a whole year, then chances are you're not coming home. And if you think you're coming home, well, then come home, sleep in the bed, and reset the year. So when the home is no longer your primary home, the loan comes due, and that's typically death. I've had people fall, they break their hip, they go to a rehab, then they go live with one of their children until they get fully better in order for them to stand on their own 2 feet and live at home, and they're gone for 9 months. That's okay. I had a customer who bought an RV with their reverse money and went traveling. She said, I'll be gone for 11 months. She told me that. And she's that, is that okay? And I said, yes. But just make sure you come home before the year's over, before 12 months is up, and sleep in your bed. Because once a year, the lender is going to send them a letter. And they're going to ask 3 questions. Do you live there as your primary home? Did you pay your property taxes and your homeowner's insurance? And if the letter gets returned to sender, they're going to send another letter, or they're going to call. And if no one picks up the phone, they're going to call again. And if no one picks up the phone, they're going to send somebody out to knock on the door. Once a year, HUD requires an occupancy check. Of course, they're going to know if you didn't pay the property taxes because the county is going to send them a letter, send the lender a letter. But all right, next one is in Florida. How many homeowners use their HECM? Use the HECM that qualify? How many homeowners use the HECM that qualify? If I understand your question, Daniel, is how popular is this program in Florida? Do a lot of people do this? You know, the sad thing is that no, we have several forces against us. This is a very small industry. We're 35 years old, and yet we're still a small industry. And most people don't even know what a reverse mortgage is. Thanks to Tom Selleck on TV, that's changed a lot. Before that, it was Henry Winkler, the Fonz, and we used to have a couple other famous people that spoke. James Gardner, way back in the 90s, 2000s. Anyways, even with good, prestigious actors promoting the product, there's still a lot of fear. And I think a lot of it comes from the word reverse, right? Just like one of the people said that I thought the bank takes the house, right? Because the fear is there. So as I mentioned before, what I'd like for everyone to do is start off the conversation with the word HECM, right? Would you like, you're talking to someone who's 62 and above, they're thinking about buying a home, and you want to start the conversation with HECM. Would you like to see if you qualify for a HECM? Well, what is that? If you said the word, would you like to see if you qualify for a reverse mortgage? The answer is no, right? And your job is not to sell the loan. Your job is to sell the house. No, they're not interested in reverse mortgage. But if you start off with HECM, well, how does the HECM work? Well, I'm not an expert, but the way I understand it is that it's a federal government loan that allows you to buy a house for less than all cash, and then you'd have no required mortgage payments. Oh, well, tell me more. Well, let me put you in contact with an expert. Or they may come back and say, well, that sounds like a reverse mortgage. And your answer is not, no, it's not, because it is, right? A strawberry is a fruit. A lemon is a fruit. No, it is a reverse mortgage. But your answer is not, yes, it is. The answer is, well, it's the safest loan in America. It's an FHA HECM, home equity conversion mortgage. Let me put you in contact with somebody that can explain the good, bad, and the ugly. Because everything has a good, bad, and the ugly. I don't care how perfect something is, right? There's always something bad about something that's good. It's just the way life is. All right, and that's all the questions I have typed up.
How about the income limit?
What's that?
Income limit.
I answer the income limit. There's
Did
no,
you? Okay.
yeah, there's no income limit. No, definitely no upper income, and lower income needs to be $800 a month would be a good bottom, but we don't technically have a. You know, I've actually done loans for people with no income at all, but they had lots of asset, and we used the asset to pretend it was income. So there's that. I've got one client right now who has no income, zero. She's 67 years old, has zero income. I said, how are you living? She says, I got retirement. I mean, I got money in the bank. She says, I'm down to 50,000, so I'm a little bit worried. And I said, well, aren't you going to do Social Security when I'm 70? I said, why are you waiting till 70? She says, because I get a larger income check or Social Security check. I've got enough money in the bank to last me the next 3 years, but I'm worried that I may not. And I'm also worried that I want more money as I get older. So I want to do a HECM to supplement my Social Security when I start it in 3 years. So she has no income whatsoever. And we can get her qualified. She hasn't actually applied yet, but she's going to. But we're going to get her qualified. We're going to get her qualified for 2 ways. She has a $350,000 house with no mortgage payment, which we would pretend that the money coming from the house using the HECM is cash in the bank, which we can pretend is income. we're taking her $50,000 and pretending it's income. So between the two amounts of money, based on her age, she has enough assets to pretend she has enough income. She has no debt whatsoever, which means all we have to qualify is $527 a month, plus taxes and insurance. She has no HOA. So in other words, I guess there's no limit on income. It could be zero as long as there's assets. This is the easiest loan to qualify for. Easiest loan to qualify for. Okay, here's an example of one of our realtors who took this program to the next level and had our marketing department, and Don Mulcahy, by the way, would help you with this. But we created a flyer at no charge to the realtor to promote his listing. Now, I'm going to let you digest this brochure real quick, but this is a true listing in the Villages. This house is for sale, was for sale, sold now, but for $629,000. And if you look at the green box on the right-hand side, it gives you some different ages. If you're 62, what's the down payment? If you're 72, what's the down payment? If you're 82, what's the down payment? So read that, digest it real quick, and I'll get going. All right, any questions?
Mary Mitchell had a question about is it required to be an FHA loan? It is an FHA loan.
Yeah, this is an FHA loan. The rules for the FHA HECM are different than the FHA conventional, than the
Right.
FHA mortgage. They're mostly the same. It must be a move-in ready house, no fixer-uppers. Everything's got to work. There's no repair set aside. It must be, it must fall within FHA lending limit guidelines, which is 1.2 million. We'll go over that in a few more slides. But it can be any kind of a house. It can be a duplex, a triplex, a quadplex. It can be a zero lot line. It can be a condo. It can be a cluster home, a single family home. It can be a manufactured home. So the next question from Mary is, are there any locations, neighborhood requirements? In other words, does FHA need to approve a particular house or a certain area? Well, okay, I kind of answered that. How strict is the FHA inspection? Okay, let me go ahead and re-answer that. So FHA is going to do an appraisal. It's going to be under FHA appraisal guidelines, so it must be move-in ready. No repairs required. If there's any repairs that the inspector notices, they've got to be fixed before closing. On a purchase, on a refinance FHA HECM, we can do a repair set aside, and we have 6 months to fix it. There's no neighborhoods that are banned, with exception of if it's leased land. There's additional requirements. If it's a land condo, I kid you not, there's actually, when we think of a condo, we think of a high rise, right? But there's actually land that's classified a condo, and everyone lives in their own home, but everyone owns the land. And Bay Hill, which is one of the sections in Bay Hill, which is a prestigious neighborhood in Orlando, where the famous golfer, oh my gosh, I had my picture taken with him. In any case, how do I forget his name? I got his picture right over there. In any case, sometimes manufactured homes are in a land condo. Leased land is pretty common in manufactured home neighborhoods, but I've also seen stick-built homes on leased land. So those have additional rules, but FHA does do those loans. Condominiums are hard to get approved under FHA guidelines, but they can be approved. Usually we go proprietary, a portfolio on those. But there's no area that's banned, right? That would be called redlining, and FHA doesn't do that. So the quick answer to your question, Mary, is that we can do a HECM on just about any property located anywhere, in the middle of nowhere or in the middle of downtown big city. There just has to be comparables for that house. I tell you what's also difficult is log homes and what they call those dome homes, right? There has to be comparables. So a log home is difficult because there's usually not very many comparables in the area. So there's got to be comparables. Usually we do 5 acres, but if it's usual and customary for the area to have 20-acre lots, and there's comparables, we can do it. Next question from Vanessa is, when can we make a flyer? Send an email or call Don. In fact, Don, in the chat, put your phone number and email address in the chat, and Vanessa can look that up. But he'll need your listing, picture of the home, or maybe a link to the listing, and we can get our marketing department to create a flyer for you. And again, there's no charge for that. All right, let's move on. I want to keep this thing on time and try to be done early. All right, so I love this question. If you think about this, it makes a ton of sense. It's a rhetorical question, but still, if all homes right now were discounted by 30 or 35% to people that are 62 and above, if all homes in the state of Florida were discounted by 35%, the catch is there has to be a cash buyer. How many homes could you sell if they were discounted just today and today only? And the answer is all of them, right? And that's what we're doing. You can help someone move from their existing home that might be needing repairs or in a bad neighborhood, or maybe it's not a 55 plus community, and you can move them into the right home at a 35% discount. That's pretty cool. And if you sort of start thinking that way and talking that way, you should get excited when you're talking to a retiree. Let me help you into the house of your dreams. I can sell your $500,000 house and help you into a $750,000 house with just about nothing out of your pocket. We'll take the proceeds from your current sale number one, and we'll help you buy your second home, your dream home, the one that's on the golf course, the one that's on the water, this one that has the pool and the jacuzzi, the one that's in the 55 plus community. And there's sale number two for you. If you want to own a 55 plus community, if you want to be able to beat out the realtor that's been so embedded in that community for years, you start offering this program. And next thing you know, the people in the front of the community that want to move in the newer section, which is in the back of the community with the bigger homes and nicer places, are going to start calling on you. And before you know it, the existing entrenched real estate agent is not even going to know what hit them, because you have a program that they don't know anything about, and they should. I don't know if I finished that question earlier about, how common is this loan in the state of Florida. I'm going to restate what I said before. 97% of real estate agents don't know anything about this program. 97%. 3% know a little bit. And you, 1%, know everything. You're going to know enough here to be able to change your career this year. Now, earlier, Don asked me a question. What about the non-recourse? All right, your other option, when the kids inherit the house, this is a non-recourse loan. Or mom and dad decides to move because the house isn't right for them anymore. But they find out that when they're done with the property, the house is worth less than what's owed. Now, that can happen a couple of ways. 2008, 9, 10, we had a housing crash. Before that, we had a housing boom. People were doing HECMs left and right in 2005, 6, maybe even 7. A lot of equity was extracted. FHA was very generous on how much they're willing to lend. Back then, it was 50-50. Right now, we're more like 65-35. FHA was super generous, and people were pulling out all sorts of money. And then the recession hit, and these $300,000 houses were now worth $150,000. But someone had borrowed $150,000 using a HECM a couple of years ago. And now they owe $175 on a house that's worth $150. All right, that's one way it could happen. Another way where a house could go underwater is if a person does this loan at 62 and they wind up living to 95. And over the years, the compounding of interest has exceeded the value of the house. And a lot of times, senior citizens don't maintain their house like a younger person because A, it's expensive, and B, is everything they do now has to be hired out. They really can't do the work themselves. A lot of homes just fall in disrepair, so therefore the house is worth less. So if there's ever a time that the home is worth less than what's owed, all right, underwater, if there's ever a time when mom and dad are done with the property, usually it's because they both passed on, and it's determined that what's owed is more than what the house is worth, then the other option is that the homeowner, the kids, mom and dad, whoever the homeowner is, when they're done with the property, if it's determined that the house is underwater, they could hand the keys back to HUD and walk away. And the definition of non-recourse is just that. There's no recourse. There's no recourse to anything. The FHA will eat the loss. And how does FHA, the federal government, eat the loss? Well, because in order to do a HECM, an FHA HECM, there's an insurance fee. When you do the HECM, when you go to closing, 2% of the appraised value goes into a trust fund. This trust fund currently has hundreds of millions of billions of dollars. Hundreds of billions of dollars. If we have another housing recession in all 50 states, there's enough money in this trust fund to bail out all those that are underwater if they were done with the house during the recession. Because remember, this is the lifetime loan, which means there's no estate hit, there's no IRS judgment, no IRS hit, there's no IRS bill. The kids can take the Cadillac out of the driveway and all the diamond rings and all the furniture and hand the keys back to an empty house and say, take it. No recourse. What if the kids wanted the house? Now, they don't want to pay more than it's worth, but what if the kids did want the house? FHA has a Part B to this. FHA says that, okay, fine. If anybody, especially the family, wants this house, we will give you a clear title for 95% of what the home is currently worth. All right, let me give you an extreme example. The home is currently worth $300,000. Let's just say the debt is $400,000. What's owed on the HECM is $400,000, but the house is only worth $300,000. It's underwater by $100,000. FHA will release a clear title for $285,000. Good deal. If the kids wanted the house, if the family wanted the house, they get first right of refusal at 95 cents on the dollar. Now, when you put all this together, the FHA HECM is the safest loan in America. It's not the loan of last resort. It's not run from a reverse mortgage. This is, you should never do one of those. You're going to regret it. Oh my gosh, let's not even talk about it. No, it is the safest loan in America. It's the easiest one to qualify for. There's restrictions. You have to be 62. It's got to be your primary home. You got to put a substantial amount of money down, but it's the safest loan in America. Any questions? All right, I see two questions. Oh, Vanessa says thanks. And Megan says, oh, we're still in the basic auto plan with 30 days. All right, moving on. Okay, so what does this loan do? Well, when the borrowers, either one, permanently ceases to live in the property. When the borrower or non-borrowing spouse. Now, what's a non-borrowing spouse? Okay, your client's 62 and they're married to a 50-year-old. Well, we have a borrower, 62, and then we have a non-borrower who's 50. All right, guess what? They're both protected under this program. One is considered a borrower, and one is the spouse to the borrower. But both people are protected under this program. In other words, neither one can be kicked out, and there's no required mortgage payments forever. When the last spouse or borrower passes away, or non-borrower passes away, or if you fail to comply with the terms of the mortgage contract, that's with any mortgage contract, VA, USDA, conventional. If you don't pay your property taxes, the county's going to take it. If you don't pay your homeowner's insurance, the association dues, you're going to lose your house, right? Those are the terms of the contract. And the reverse, the HECM is no different. It's the same terms. Got to maintain the house. You got to replace the roof when it's needed. You got to pay the HOA dues and so on. So what are the eligibility? Well, borrowers have to be 62. Spouses can be age 18 plus. You think that's crazy? I had a 72-year-old look into one with a 72-year-old man married to a 25-year-old spouse. Yeah, there's a big age difference. So there's a story behind that. We got some laughter. I'll tell you then, all right? So, a true story. This happened a couple years ago. In other words, he wasn't 72, he was like 69. So when he was in his upper 60s, he went down to Dominican Republic, and he fell in love. He's a white guy, and the locals were black. And he fell in love, and she fell in love, and they decided to get married and come back to Florida. Now, the funny part of that is that she didn't speak any English, and he didn't speak any Creole. I guess it's Creole, right? Uh, so they just communicated with love, and they got married. And fast forward, she was 22, I think, at the time. Now she's 25, and now he's 72. And they didn't actually do the loan because we had to base it on her age. And he had this is probably 10 years ago. Um, he lived in Tampa in a condo, and we could do it under the FHA guidelines, but the amount of money that he could borrow on a $200,000 condo, I think, was 50,000, and which is a lot of money, no mortgage payments, and he just didn't feel like that was enough. Now, the way I look at it is, first of all, it's a cash injection into the household. That's good. No required mortgage payments. And at age 25, she could live there the rest of her life with no mortgage payments. Now, she's got to pay the condo dues, the property taxes, right? But there was no required mortgage payments for the rest of her life. That could be another 50, 60 years. Now, in reality, he's a male, he's older, he's going to pass away, and she's going back to DR. You know that's going to happen. But that's on them. Whatever's good for them. I'm not here to judge anything. But they wind up not doing the loan. I really don't blame them, but that's the rest of that story. All right, so the last bullet point is they must have the right to live in this country or territory. U.S. citizenship is not required, but they have to have a Social Security number. They have to have some way of proving that they have the right to live in this country and that they are potentially tax-paying people. So they have to have a Social Security number. And I have a Canadian right now who can't seem to get a Social Security number. He's trying really hard, and he's retired, so he has to have a job in order to get a Social Security number, but he can't get a job because of everything that's going on with immigration. So he may not be able to do a loan in Florida, but he's trying. All right. So for the property, this was an earlier question. So no second homes, primary home only. Some of the proprietary loans will do second homes, but I don't know enough of the requirements. If you happen to have a borrower who wants to do something on a second home, get with me, and I'll do some serious research and let you know how that works. So pretty much every property qualifies: townhomes, villas, cluster homes, modulars, manufactured homes, so on. New construction, we can start the application before the home is finished, but we can't close until the CO is issued. It can be up to a quadplex. Now, this is pretty cool. I'm going to discuss it probably a little bit later if I have time. It's already 26 minutes after. But think about this. If someone purchased a duplex, they could live in one side and rent out the other side. The other side would be pure income for your client. Triplex or a quadplex. They buy a quadplex. Maybe it's $1.2 million property. They do a HECM, a large down payment. They live in one of the plexes and rent out the other three. All that is cash flow. All that is building wealth for your client. It's a good financial plan. So if it's FHA, if it's a condominium, it must be FHA approved, which is kind of difficult right now. But portfolio HECMs just require a condo questionnaire. So we can do pretty much any kind of property relatively easily. Single family homes and a condo are usually okay. We just have to give some condo questionnaires. The home must be move-in ready, FHA, no fixer-uppers. And boy, I tell you one thing, I had an FHA inspector, appraiser, notice that there was no shower head in the shower, no nozzle up in the shower, and required that to be fixed before we could close. Now, how easy is that to fix? Just screw one on, right? But we could not, because it was a purchase, we could not do a repair set aside. They actually had to go in there and put a head on it. It is what it is. Manufactured homes, single wides are allowed as long as they're not super small. Leased land, we can get those done, but there's so many rules against them that they don't work in our favor. But if you have a manufactured home on lease, if you have any kind of a property on leased land, don't discount it. Let's do some research. Let's get a copy of the lease. Let's see if it's worded properly. And then manufactured homes and a land condo are difficult to get FHA approved, but I've gotten them approved before, so let's not discount it. All right, moving on.
I have a question, Tim. Tim, if a customer If a house burns down and the insurance company pays the homeowner for the house, who gets the money?
Well, the answer is the same with any mortgage. If you had any kind of a mortgage, or if you had no mortgage, the answer is all the same. The insurance company is going to pay the homeowner. There's a lien against the property, so the insurance company is going to pay the lien holder first what they're owed, and the difference is going to go to the homeowner. The idea behind homeowners insurance is the home is going to get rebuilt, but depending on how severe it is, the home may not get rebuilt. Right? You might just say, "Just give me the money, I'm going to walk." But that has really nothing to do with any kind of a mortgage attached to it. It's really if you're properly insured, there's enough money to either pay off the loan, give you the difference of what the property is worth, or rebuild. The mortgage company is only involved because there's a lien against it.
Well, it
Again,
seems
that's
to me a lot of people, and it recently happened with one of our closing deals, think that the lender owns the home.
no.
And this is no different than any other mortgage. The person who buys the home owns the home.
Yeah, thank you for explaining that. Let me give you an example of that. I love the VA example because here's an extreme example. If someone buys a $500,000 home using a VA loan, they put nothing down because that's the idea behind a VA loan. They put nothing down. They close. Today they close the loan. They bought a $500,000 house with no equity. The house is worth $500,000 and they owe $500,000. There's no equity. First question is who owns the house? Well, the homeowner does. The homeowner owns the house, and the proof of that is, well, who pays the property taxes? Not the bank, right? The homeowner does. Now, maybe they have it built into their mortgage payment, but still, the homeowner pays the homeowner's insurance, the HOA, and the house. Why? Is because they own it. They have a lien against it, but they own it. If the homeowner the very next day decides to sell the house for $550,000, right? Somebody walks up and says, "I want to buy this house. I'll give you $50,000 more than you paid for it." Who gets the profit? The bank or the buyer? Well, the answer is the VA person, the buyer, because they own the house. He pays back the $400,000 or $500,000, and he keeps the $50,000. If the buyer decides to sell the house for $450,000, well, now the buyer's got to pay the bank the other $50,000, right? Because the lien holder is just that. They're just a lien holder. They're in the money business, not the house business. They just want their money back. Hopefully that answered your question. All right, I think there's another question here. Nope. Whoever's doing this AI recording, they sure do interrupt. All right. So down payment. You cannot borrow money for the down payment. You cannot borrow money for the down payment. It's got to be your own. It can come from your checking, your savings, your CDs, investments. It can come from a recent home sale or maybe a pending home sale. There's no seasoning requirements. Retirement accounts, withdrawals, IRA, 401ks. You cannot borrow from yourself. You cannot borrow from your IRA or 401k because that's borrowing, but you can certainly withdraw from your 401k. You got to deal with the IRS tax consequences, but that's secondary to this. I've had people take money out of their whole life policy, the cash value. I had a person who sold some golds. They had bars of gold, I kid you not, in their safe. They had serial numbers on them so we could trace the gold bars from the purchase to the sale. I had a guy who sold a vehicle, $4,500 on eBay, and we could trace the sale of that vehicle, including PayPal, and that was allowable money because we could trace it back to the car he owned, which was an asset, just like the gold is. And then guess what? The very last bullet point is gifts for not only family, but also your friends can gift you money. And I did have a friend, I did have a client whose friend of 30 years gave him $50,000 to add to his already couple $100,000 to buy a house. Now that's a true friend. Now, I don't know if they had a side deal on the back. I know nothing about that. But the fact is, gift from a friend, and we could document that. He gave him $50,000, and we got the loan closed. So, what is not allowed as a down payment money? Well, once again, you cannot borrow money to borrow money, right? You cannot borrow money. No home equity loans from the second home. There's an asterisk right there. No any type of subordinate financing. In other words, a down payment assistance program, even though that's not technically financing, a lot of time that's a grant, it's still subordinate, not allowed. First time home buyer assistance programs, there cannot be any other outside influence of this. No personal loans or advances on credit cards. And I've had people put their earnest money down using a credit card. No, can't do it because that's borrowing money from a credit card. Now we got to pay that credit card off, or at least the amount that you used. Loans against anything. You cannot borrow money from your 401k, life insurance, because you cannot borrow. You can withdraw, but you cannot borrow. Now, the asterisk means this, that yes, you can get money from a second home, an investment property, but it must be seasoned in your bank account for 2 months. And it's going to show up on your credit report, which means that you must have enough income to be able to afford the monthly payment on the loan that you just got on your investment property. But is it allowed? Yes, because it was seasoned for 2 months. Again, the math has to work. Do you have enough income to afford all your bills and have $527 a month left over to buy groceries if you're a single person? Okay, so how much is this going to cost your client out of pocket? Okay, we know about the 65% down, approximately. Could be 70% down, could be 60% down, but in that range. There's going to be an appraisal, depending on the value of the house and the location. It's going to range somewhere between $625 and maybe more. The counseling fee is mandatory. It's 30 to 60 minutes. It's usually about $150. If your client calls a counseling agency and they want $200 or $300, hang up and call somewhere else. And we can give you a list of all the counseling agencies, all the big ones in America and all the big ones in the state, by just asking Don, and we can get you a list if you're interested in the list. But it's over the phone, so you could call somebody in California. It doesn't matter. Nevada, Florida, there's plenty in Florida, but it's all over the phone. If your client really wants to do it face-to-face, there is a few agencies that'll do that face-to-face. No one really wants to because it's time-consuming and it takes usually a couple of hours because of all the chit-chat. But there's a few around that'll do it. Traditional closing cost. This is a mortgage. You have doc stamps, intangible tax, land survey, title insurance, all the stuff that goes with mortgages. FHA charges a trust fund fee, an MIP as we call it, mortgage insurance premium, not private mortgage insurance, but same thing in reverse. So FHA charges this fee. Of the appraised value, it's 2%, not of the loan amount, but of the appraised value. So on a $300,000 house, there's a $6,000 one-time fee going to FHA's trust fund. But that's what makes the program work, because what bank in their right mind would loan hundreds of thousands of dollars with no required payments for life, right? It's what makes the program work, and at a reasonable interest rate. 6.5% is what the FHA program is going for now. The portfolio HECMs are closer to 9%, but there's no FHA fee. It's not an FHA loan, which means the borrower saves 2% off the top. So think about this. If your client wants to buy $1 million home and they do it under the FHA program, that's a $10,000 fee going into the trust fund. Now, again, it makes the program work and it's money well spent. $20,000 on a $1 million property. $20,000 is part of the closing cost. It doesn't come out of their pocket, but it's added to the loan balance. It doesn't change the 65%, but it's added to the loan balance. It's a $20,000 fee, but they get a reasonable interest rate for that. Portfolio loans, there's no PMI, no MIP. Therefore, there's no $20,000 fee on a $1 million property, but the interest rate goes from 6 to 9. So there's pros and cons with everything we do in life. The origination fee is no more than $6,000. That goes to the lender to be able to keep the interest rate low and to make this program work. It's added to the loan balance. It doesn't come out of the 65%, but now we're at $20,000 for an FHA property for $1 million and $6,000 for the lender. So we're at $26,000 in closing costs, and you still have all the third-party fees, the title insurance, the doc stamps, intangible tax, the land survey. So you still have another 10 grand in fees there. So you might want to say, well, $36,000 on a $1 million house, that's a lot of money. Well, you know something? That's pretty much in line with any kind of financing. The 9% is pretty much in line with any kind of a jumbo financing. So it is what it is. And that's something that we would discuss with your client to determine what makes sense, a portfolio loan versus a HECM, FHA HECM. And we would look at all the fees. Now, the FHA HECM has a lending limit max of $1,249, so the very last line. In other words, FHA wants to do this kind of a loan on a house that's worth $1.25 million or less. It doesn't mean that FHA won't do it on a larger value property, but when it comes to calculating the down payment, the 65%, they're going to calculate it on the 1.2 million. Anything above that is paid dollar for dollar out of your client's pocket. So in other words, your client wants to buy a $1.5 million property. They've chosen not to go the portfolio route for whatever reason. They don't like the 9% interest. They can do it with an FHA HECM, but FHA is going to do 65% of the 1.25 million, and then every dollar above 1.25 million is going to be an additional down payment by your client. So let's put this in real math. 65% of 1.25 million is 750,000. That's about right. So they're going to put $750,000 down on a $1.25 million house, plus an additional on a $1.5 million house, plus an additional $250,000 for the difference. So they put $1 million down, but they're buying a $1.5 million property. Right? That's a good deal, right? They're buying a $1.5 million property for $1 million cash, no required mortgage payments. That's a hell of a deal. All right, we don't have time for this, but I did want to reiterate the fact that there's all sorts of ways to enhance a person's net worth and definitely cash flow by doing a little bit of financial planning and using home equity as the tool to make sure that your financial plan lasts to age 95, regardless if you have $10 million in the bank, $20 million in the bank, or $200,000 in the bank, or $2 in the bank. Home equity is critical in order to have a retirement plan last. And as I mentioned before, I have a client who is delaying her Social Security to age 70 in order to maximize her Social Security check. And she's going to do that using a HECM. She's getting ready to apply any time now. She made it to 67, but she has 3 more years, and she's worried that she may not make it if something happens to her, like a roof on her house or something. She may not make it for another 3 years, so she's going to use a HECM to make sure it does happen. And then at age 70, she might start paying back the HECM, or she might just say, well, why? And by the way, she has no kids, so there's no reason to pay it back, right? Just go on vacations. So I did mention this earlier, but I want to stress this I want to stress this again. If you look at the amortization schedule on a regular mortgage, approximately the first 10 years of your mortgage payment is going to interest and not to principal. When one of your clients says, yeah, but I want a regular mortgage payment because I want to build equity for my kids. Well, first of all, the kids are going to sell the house. As soon as you die, the kids are going to put it up for sale. What are you going to do with 2 kids in one house, right? You're going to sell it in order to divide the money up. All these people want to say, I want to leave something to my kids. Well, you know what the kids really want? They want the cash. So how about this? How about not having a mortgage payment and help your kids out now? How about giving them cash for Christmas? Because all kids, I'm exaggerating, but all kids need help now. Grandkids need help now. There's the prepaid college fund. There's all sorts of ways to help your family out now while you can enjoy the love of the donation versus waiting it to become inheritance money, death money. So a HECM makes a lot of sense. Again, the second bullet point that's in bold is heirs usually sell the house that they inherit. They want the cash. And a quick story, I had a customer, I'm going to run out of time, so I better keep going here. But a quick story, I had a customer who was getting $60,000 more from their HECM that they wanted. They had this in their mind, they wanted this much money, except their house appraised for more than they expected. And they were getting $60,000 more, and they didn't want the money. Just keep it. Okay, we'll put it in the line of credit. You don't have to take it. But I want it if you're going to give it to me. Well, but I don't want to pay for it. I said, well, either leave it in the line of credit, and that way you're not being charged interest on it, or give it to your kids for Christmas because it was October of the year. And I said, how many kids do you have? Well, my kids aren't kids. They're 60 years old because they were in their 90s. I have 3 girls that are 60-ish. I said, why don't you write them a check for $20,000 each and call it a day? So I called her back in January, and she said it was the best Christmas ever. I said, did you give them $20,000? Oh no, I gave him 5,000. It's one of my favorite stories. Okay, so one thing a person can do, especially if they're 62 and still working, you know, currently it's supposed to change, but currently, if you're still working at 62 and you're drawing Social Security, then if you make too much money, you got to pay taxes on your income or taxes on your Social Security income at 50%, 50. And I believe under the Trump administration, he's going to change that. But currently, if you're working and you're drawing Social Security at 62 to 67, you got to pay upwards of 50% taxes over what you're allowed to make. Well, why not do a HECM to avoid that and delay your Social Security until you actually fully retire? Again, we're skipping over all this because we don't have time. But all right, so your job is to sell the home. Your job is to sell the home, not to do the loan. Your job is to help a customer make a decision. If it's a rural property, maybe 0% down USDA. Maybe if they're a veteran, maybe a VA loan. Maybe, a FHA HECM, maybe a regular FHA loan, 3.5% down. Maybe a conventional loan, 20% down. Less than 20%, they get PMI. If the HECM is the right direction, 62 and above is the ideal age. Get a hold of your HECM specialist, your loan officer, and let them get their income verified, their credit, the assets, get a pre-approval letter, and then go home shopping. Go home shopping. Now that you know how much your clients qualify for using a HECM, now go home shopping. You've got a pre-approval letter. Go get a purchase contract. Fill that thing out the way you normally fill it out. If you're doing the FHA HECM, check off the FHA box and complete it the way you would normally complete it. Nothing complicated. If the seller wants to make concessions, that's fine. They can do up to 6% of the purchase price in seller concessions. So down payment assistance, they want to give a golf cart away, they want to upgrade some stuff, whatever. 6% seller concessions is allowed under this program. The loan officer is going to verify that if they're married, they have $886 worth of leftover money after their credit report expenses and property charges. If they're single, I said 627 earlier, 629 is the number. They cannot be delinquent on federal taxes, means they cannot be delinquent, keyword delinquent, on student loans, or U.S. student loans, government student loans, FHA or VA loans. They cannot owe back taxes. Now, if they're on a payment program, that's fine. But if they're delinquent, they don't qualify. They've got to get on a payment program, and then we can get them qualified. We do not use a credit score. We do not use a credit score for the FHA HECM. We look at the credit report, but we don't use a score. All right, again, fill out the contract the way you would normally fill it out. We do not have TRID. We do not have a settlement statement. We use the HUD-1. We use the HUD-1. We're old school. Don't know why. It's just the way FHA has done this. We don't have all those TRID requirements. This is a whole special loan. It doesn't fall under the FHA umbrella the way FHA loans do. It has its own umbrella. So fill out the sales contract the way you would normally fill it out. There has to be a contingency for home inspection. We don't require it, but the customer's got to be allowed to do that. There's an FHA mandatory clause or real estate certification form because this is an FHA loan, 6% of seller concessions. And if you think you know FHA loans, you don't know FHA HECM loans. They are calculated differently. I would recommend that you use an FHA, a title company that the lender recommends, only because things are different. Again, we use the HUD-1. We don't have TRID. We calculate things differently. So we're not going to lose a deal over a title company, but I would highly recommend that you use the lender's title company. It's going to be the same cost. It's just you get the loan done in 4 weeks. And if we make any mistakes on the purchase contract, there's this beautiful magical thing called an addendum. And this is just curiosity stuff. The average age is 72. There's no upper age. You can be 106. One of my employees 15 years ago did a loan for a 106-year-old. Why would they do that? Well, in this case, they needed home health care and they didn't have any money, but they owned a home that was free and clear. And maybe they had 6 months to live statistically, but the difference is going to a nursing home or doing a loan. And guess what? They qualified. And when it comes to seniors buying houses, I had a 90-year-old personally. I had a 90-year-old buy a house. Why? Because she was living on her first floor in a 2-story house, living in her living room. All right, 90 years old. A 90-year-old's not dying anytime soon. In their own mind, they're living to 100. And with the right attitude, they probably will. So whether they're 62, they're 55, or 92, it just so happens that the average age is 72. All right. So once again, the lending limit for the FHA is 1.2 million. For the portfolio loan, there's no real limit. $30 million home, $25 million home. Uh, and a person with the ability to buy a $20 million home doesn't necessarily want to use $20 million of their money to buy a home, right? They've gotten rich by using other people's money. They're into leveraging. So a person can purchase a $20 million home for approximately $13 million. Now, I don't know what the commission is on that, but it's more than a normal paycheck, right? So don't limit yourself. I have some real estate agencies in the Central Florida area that won't talk to me because their clients are millionaires and they don't need something like this. Now, to me, that's completely short-sighted, but I'm an education kind of a guy, and I'm not going to high pressure somebody. But it's really sad when someone says, "Yeah, I'm not going to talk to you. My people have all cash." Yeah, but you're doing a disservice to your clients. How many multimillionaires have gone belly up, right? Because they weren't able to leverage things properly or they didn't manage their money properly. Rockefeller, J.D. Rockefeller used to be the richest man in the world, right? One of his famous quotes is, the best way to get wealthy is to use other people's money. Enough said on that. Can you sell a home for $1 million? Yes, 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 yes. So we're out of time for this, but we have 10 minutes to go. But let me just run this through real quick. If I'm talking too fast, I'm more than happy to share these slides if anybody wants them. Just get a hold of Don. Don, you put your info in the chat, I think, right?
Excuse me?
You put your info in the chat, Don Mulcahy at HECMAssociates.org. Anyways,
So
do
I
that.
know how to do that, Tim. How do I do
All
that?
right. Well, all right. Well, don't worry about it. In a
Well, I'll
couple
be in
slides,
touch with everybody. I'll be in touch with everybody over the next few days.
all right. So here's something that's interesting: is 13,000 people are turning 62 every single day in this country, according to the U.S. Census Bureau. 13,000 people are turning age 62 every day. That's a lot of people moving to Florida. Oh wait, only 1,000 of them are moving to Florida, well, of all ages. But still, there's a lot of people that are turning 62, which means lots of new customers out there. That's every day. Multiply that by millions over a couple of years. 24% of the home buying population in Florida are 62 years and over. According to NAR, 35% of all home sales in Florida last year were sold to people that are 62 plus. Isn't that amazing? I've had realtors tell me, "Oh no, I only specialize in millennials." Well, that's fine. Nothing wrong with specializing. I'm a big fan of that. But when 35% of all the home sales are going to seniors, there's a big bucket of customers that people are missing out on. 40% of the U.S. population are planning on moving to Florida, I'm joking, in retirement. 77% of the nation's wealth is controlled by our seniors, cash buyers. And we want cash buyers because 65% down is a lot of money. That's $17 trillion that's controlled by seniors. 86% of seniors want to age in their own home. And a lot of seniors, especially up north, live in two-story homes. But as we get older, people start thinking about that. They want wider doorways. They want single-story property. They want 55-plus homes. They want a lot of things. And this is your opportunity to go into disadvantaged neighborhoods or older neighborhoods where homes are starting to need some fixing up and helping people move from their existing home that's not in their best interest into a brand new home with a brand new roof and a new air conditioning, no maintenance required until it starts wearing down. And again, one more time, AARP says that 96% of the people that have ever completed a HECM are completely satisfied. So don't let anybody say reverses are bad. HECMs are bad. So why should you target the senior market? All the things we've talked about. And we talked about helping people move into maintenance-free lifestyles, maybe a condo, a patio home, maybe with no out-of-pocket costs. Helping people move from a manufactured home into a stick-built home will actually enhance their net worth. So why should you care about this? Because you want to separate yourself from the competition. You are now the informed real estate agent professional, right? You're going to have a better reputation. You're going to open new doors. You're going to help your clients sell their current home, get a commission, update their home into a nicer home, make your second sale. You're going to get more listings by using the HECM tools. And there's a few slides on that. We're not going to have time for that. But again, I'll send you these slides if you like. Don will get with you and ask you that. And you can see all sorts of things from MLS. I just hit too many buttons there. There's some MLS tools that you can use. Somebody can use their existing home to extract money in order to buy a rental property. Their existing home must be their primary, but the cash they get from it can be used for anything, including buying a rental property. Again, cash flow, increasing net worth. We talked about doing a quadplex, increasing cash flow. And I like to use the word right size, the very last word in this paragraph. They just might want to right size. In other words, I don't like the word downsize, because downsize means smaller, not so nice of a house. You know, with this program, you can have people upsize, or I like to use the word right size. Get them into the right home, in the right neighborhood with the right amenities. And then remember, we've talked about the VA loans, the FHA loans, the jumbo loans, the first-time home buyer. There's all sorts of programs out there. Always do what's best for your client. I'm a super big fan of the HECM, super big fan of the HECM. But I've recommended people not do a HECM before, because it may have been in their best interest to do something else. And there's lots of programs out there. And then what do you do with all this disposable money? You know, we talked about one of my clients giving their money for kids for Christmas. Build their legacy today instead of after they die. Help their children purchase a home. Long-term care is pretty common. This is used for. I've had people say, my car is 15 years old and it's on its last leg, and they do a HECM in order to buy a car, cash, pay off debt. And why should you do this? Well, mainly because you care. There's no reason for a senior to have the last 30 years of their life not being the best years of their life. Quality of life should not decrease with age. And then here's a good example. You know, we don't have really an upper limit on the HECM. You can use a proprietary HECM to purchase a $40 million home. Think about that. I mean, this is mind blowing, right? But the point is there's really no upper limit. There's about a 50% boost in purchasing power. $5 million down payment gets someone a $7.5 million house. Don't discount the opportunities out there just because you're selling a $5 million house, or you're helping a buyer purchase a $5 million house, because this is going to be a game changer. And then this is some of the marketing stuff. You've seen this flyer. If you start advertising this on social media, talking about 50% boost in purchasing power with this new program for seniors, whatever you want to word it. If you want us to help you word it, we will. Here's something that's been approved by MLS. You can actually put this in MLS and not trigger any kind of red flags. Ask how a buyer age 62 plus can purchase this home with just one large down payment and no monthly mortgage payments for life, or no required monthly mortgage payments for life. That meets all the compliance needs with FHA, MLS, NAR, and so on. It's very generic. It's generic enough that you don't trigger any kind of age discrimination stuff. Because if you're not 62, you can't do a HECM. You can't do an FHA HECM. So you're not breaking any kind of rules. All right. We have all sorts of programs available. Just to let you know, we have a reverse mortgage program actually called Reverse Mortgage, because no one knows what a HECM is. We have actually a government loans program going over the different types of government loans. You know, we're a school, HECM Association is a school. We have a whole program dedicated to just the proprietary. This program today has been sort of rounded of everything. We can actually do this in your office. If you get 10 agents and you want to have a sort of a private class, we'll Zoom ourselves in and give us to your office. And there's the contact information for the HECM Association, which comes to me.